Welcome to Brick by Brick. Join me, Lauren Wernette, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. And welcome to Brick by Brick. I'm Lauren Wernette, your host of this podcast. Today we have a great episode talking all about fund structure. Now, as some of you may or may not know, I currently operate a fund. We are a debt fund focused on our hard money lending business. But as an investor, you need to be aware of a lot of the different types of fund and investing structures out there. And we wanted to go through some of those, talk about what they are, where you're most likely to see them, some of the pros and cons of each, and talk about just some of the experiences I had with them and why we set ours up the way we did. So if you're interested in funds, whether you're a new investor looking to start a fund, you're looking for passive investments using funds, or you just have a general interest in funds, this is a great place to get some high-level information about those funds and just learn more so that you can make better decisions about your investing career. So one of the reasons why you should really care about the type of fund that you're looking at is each fund is a little bit different. And by each fund, I mean each fund structure. Now, within each fund structure, there's obviously going to be different operators that run their fund within that very differently. So, for example, 506C is going to be very different the way I run my 506C versus how someone else runs their 506C. But the general outline that the fund has that's generally dictated by the SEC or the Securities and Exchange Commission should be the same. And you as an investor should be aware of what some of those general overarching rules are so that you don't go into it and see that, oh, it's a 506C, but I know my buddy's in it and he's not an accredited investor, right? That's a big watch out, because those implications, if the fund manager is not following the SEC guidelines, could have implications on your capital that you have in there. Could cause your capital to get frozen, could cause the fund to not be profitable, could cause the SEC to come after it, could cause more audits. There's lots of things that could happen. I'm not trying to scare you. I just want you to understand what the different structures, high-level structures are, so that you have the best information possible when trying to make a decision. So let's get into what kind of these different structures are. Now, as you look across most of the funds, and when someone says a fund, what are they referring to? They're referring to basically a pool of money that private investors have given to some other investor to manage, and those funds are used for a specific purpose. So a good example of a very commonly understood or known about fund would be like an apartment complex syndication fund. So in this example, an operator, someone that does the hard work, right, or otherwise known as the GP or general partner, they're going to go out, find a deal, in this example, a large multifamily property that they think is going to make a bunch of money, but they need capital in order to purchase this property because they need money for a down payment. Maybe they're going to buy the property outright without a loan. Maybe there's renovation costs, but let's say it's $100 million acquisition. They maybe don't have the $20 million that they need to purchase that property because 20% down. And maybe they need 20% down, plus they need another $5 million for renovations to bring it up to market, to increase the net operating income so that the value of the property goes up, something like that. And so what they're going to do is they're going to put a fund together. Now, this fund is going to be structured in basically this kind of the same way across a lot of these different types of funds, where there's going to be two entities. One entity is going to be the manager entity, which is the general partnership or GP. The general partnership is where the sponsor or the operator, their interests lie. right? They're the ones that are dealing with the servicing. They're going to be operating the fund. They're going to be sending your payments out as the investor. They're going to be making sure the property is performing. They're going to deal with the liquidation. They're doing all the heavy lifting. They're going to find the property, depending on what's going on. They're doing all the heavy lifting. Then there is the LP. Now, the LP or limited partnership is the second entity, and this is where the funds are held. This is where you as a passive investor are going to have your investment. So let's make up the names. Let's say one GP is, make it simple, the GP LLC, and then there's going to be the LP or limited partnership LLC. Now, when you as an investor go to invest, you're going to not only sign an operating agreement within that LP LLC or limited partner LLC, but you're also going to sign a subscription agreement that indicates how much you are going to invest. Now, the general partnership, which has made this whole fund structure with the help of a fund attorney, is going to put the rules in place. So they're going to have a document that's put together called a PPM or a private placement memorandum. And it is going to be the Bible for that fund. It will tell you when you are going to get paid. It will tell you how the fund's going to make money. It's going to tell you who gets paid first, whether it's LP or the GP. It's going to tell you if there's any fees. It's going to give the general business plan. It's going to tell you what's going to happen if something goes wrong. And the major component of the PPM, and the thing that most people are kind of maybe get scared off of when they look at a PPM, is a PPM is going to give a disclosure for everything and anything possible that could go wrong. And the purpose of this is to limit liability to the general partnership. Because if they can disclose it in that PPM and make you as the investor aware that it was a risk going in, then if there's ever a lawsuit that needs to go against the GP has a signed document or a document that they say that they provided to the LP that says, these are the disclosures that we provided, that this could happen, this did happen, and so we provided them enough information. They made an informed decision. They made the investment, and therefore I am not liable. Now, that doesn't always hold up in law. I am not an attorney. I am not a financial advisor. Take everything I'm saying as entertainment. Do your own research by all means, but something to be said. So if you're looking at a fund, make sure you are getting a PPM. If you do not get a PPM, you need to ask for one or ask for their disclosures, because you want to know everything and anything you can about that fund structure so that you know when you're getting paid, how you're getting paid, how the money is being used, what it can and can't be used. You don't want to go into a fund thinking you're buying a $100 million apartment complex and then find out that they went and invested your money in a REIT or something along those lines, right? So that's the general structure. It's also going to tell you when you're going to get paid and that kind of stuff. So in that general structure, there's basically two main kinds of funds that are two main SEC fund structures that are used predominantly. There's a lot of other types, but the two main ones are a 5B or a Regulation D B and a 50 Regulation D 506C. These came about a few years ago, and a vast majority of the funds that you see on the market that aren't REITs, aren't, mutual funds or whatever, but real estate specific funds or even some of the hedge funds, they're going to be predominantly Bs. Now, the reason that 50 is a big one is they're relatively easy to set up. Unless you get to a certain size, you aren't fully monitored or reviewed by the SEC. You're regulated by it, but they're not checking you every year. And they're easy to set up. They're easy to manage. The fund manager has a lot of control. They're very easy to structure in order to get the investors a lot of money for what they're investing. And it's also really easy to manage because they're so common, right? Some of the big downfalls of a B, and I always think of B as 506 Buddy, is if you are going to start out and you need to raise capital. With a FB, one of the main limitations is in order for the investor to be part of that, they need to have a relationship with the sponsor, which means that you and I have a relationship. We've met a bunch of times at networking events, and you come to me and say, hey, I'm starting this fund. Are you interested in investing? Great, that works. What doesn't work is I've got a 506B and I meet someone for the very first time and I say, hey, do you want to invest in my fund? That is non-compliant with the 506B general rule of law because they want you to have at least met a couple times, basically take notes of what you are meeting about, and then eventually you can talk about what your fund is, how it's structured, and try to get them to invest in you. Now, this can be cumbersome for someone that's new to starting a fund because now it's going to take a lot more meetings to get to the point of getting an investor. Maybe you don't have a big pool of capital investors that you can call on. And it makes it a little bit harder starting out. Additionally, part of that is you can't advertise. So if you have never started a fund, you don't have a lot of high net worth individuals, you can't create a Google ad or a Facebook ad or anything like that looking for looking for investors. You have to go out and meet these people face to face, meet them a few times before you can even talk about your fund. You can't create flyers, you can't do any kind of advertising. And things that count as advertising, having a website counts as advertising. Talking about it openly on a podcast like this, putting it on Instagram, putting it on Facebook, creating a flyer and leaving it at a meeting. Anything that anybody could just pick up that you've never met before, that counts as advertising. You can't do it. So that's a major limitation of the 506B. Now, one nice thing about the 506B is that some of the investors, up to 35 investors within that pool, can be unaccredited. So what do I mean by accredited? So accreditation is a term and definition that the SEC has put out that basically says that if you as an investor are accredited, you have a certain level of financial prowess and the ability to make good financial decisions because you've reached a certain level of net worth or income. And thus you can make your own decisions for you about what type of investment you would like to put your money in. This was set in place a long time ago as a way for the SEC to make sure that fund managers weren't reaching out to grandma or Aunt Jane or whoever that had the last $30,000, getting them to put that money into a fund, losing it all, and having those people out on the street. It's a type of social safety net, right? And so an accredited investor is either has an income of $200,000 or more per year for the last 2 years if they're single, or $300,000 per year for the last 2 years if they're married, with no indication that that's going to change in the coming year, or has a net worth of $1 million or more, excluding their primary residence. So all their stocks, their bonds, retirement accounts, rental properties, commercial properties, all that added together minus any liabilities they had, take out their primary residence, both the equity and liability they have in their mortgage. And if that number is over $1 million, then they are accredited. The other way is to get like a Series 7 or Series 35 license through the SEC, basically broker-dealer license. Most of the investors I deal with, actually all the investors I work with, they do not have those licenses. The vast majority of them either have the net worth in verification point, or they have the income piece. That's where I'd say it's probably 50-50 in the investors that I work with. Now, if you have been in the game for a long time, you've done some big deals, especially if you've been in there for 20 years, having a 5B might make a lot of sense because you've built up a huge network. You know a lot of high net worth individuals. You have a track record of being able to deliver value to investors. So I've got a great deal. I call 15, 20 of my investors that have worked with me before, say, hey, I'm raising $25 million for this large apartment complex that I'm buying. They all kick in $1 million. We're off to the races, write up the documents, easy peasy, lemon squeezy. We're off, we'll buy the property, and we're good to go. And we'll talk about that maybe structure in a little bit. But that's where a B really fits in, is for people that really know where they're going to get the money from. Whether it could be small. Maybe you only need to raise $200,000, but you know who your investors are. Like that one's real easy to deal with. It doesn't require quite as much tracking, although you should always track all of your numbers, make sure you're fully auditable. But it's a great, easy structure to get going as long as you have some capital available and you're not trying to go. The other one, and this is the structure that I chose when I was getting started, is the Regulation D. So very, very similar in a lot of regards to the B. The very largest difference is there's two. One is, as an investor, you have a every single investor needs to be an accredited investor that's in that. Not only do they need to tell you, yes, I am an accredited investor, but there needs to be verification that each of those investors is accredited. And what does that verification look like? So we use a third-party service that basically we push our investors to. They collect either tax documents or network documents. A lawyer reviews those and then issues a letter to them and us verifying their accreditation, which then we keep on file in case the SEC ever comes asking. We have a file for each one of our investors showing that everybody is accredited to avoid any issues, right? With a B, any accredited investor that's in there, all you have to do is say, hey, are you accredited? And as long as there's no reason to believe that they aren't and they say that they are, you can take them for their word. So that step is also a little easier with B. With C, and this is really the main reason why we went with the C route, is with a Reg C, you're allowed to advertise. So what does that look like in general? It looks like exactly the opposite of what we were talking about with B. You can create flyers. You can talk about it on a podcast. You can talk about it on Instagram. You can have a website. You can do webinars. You can hold meetings. I don't know, you rent a bus and pick up people at country clubs and take them around and try to get them to give you money. You can advertise however you want to advertise for your fund, right? It's provided all your documents are there and you're advertising within reasonable guidelines. So that was a huge reason why we went with the 506C, because we saw that the 506B, while having benefits, we figured that we were going to outgrow my network of private money investors relatively quickly. I figured I had about $1.5 to $2.5 million worth of capital within my current size of my network. And we wanted to, raise somewhere around $10 million. And so we went with the C. We paid extra money to get those documents created by our fund attorney. And then we went forward and we started advertising. And our primary advertisement method has been a funnel that's having customer or investors driven to us through Google Ads, right? And we've raised a significant amount of money doing that route. And we're still using that path today in order to identify new investor leads, vet them, talk to them, take their investment, and nurture them over time. Like I said, the biggest downfall is that they all have to be accredited. But on the other side of that, that's a good thing too, because if everybody's accredited, then the playing field's the same. There's a lot less disclosures you have to give to the accredited investors that you would have to give if you had a mixture of accredited and unaccredited investors in there. And once the fund is set up, depending on how the fund is set up, it's set up. It's not like there's a reoccurring cost besides maintenance, audits, things like that over the course of time. So we chose to go the 506C route. A lot of people swear by the other route. I think it's just a matter of how you want to do it. What is the timeline that you're going to have your fund on? From an investor side of things, the only things that I would look at from an investor side of things, whether it's a 506C or 506B, is if I found them on Facebook, right, or Google or whatever, and I find out later that they're a B and they're not supposed to be advertising, that's a red flag. Additionally, I would want to know, hey, if this is a B, do you have any non-accredited investors in this fund? And if so, do you have additional disclosures that you need to provide to me that just saying that, hey, you're a non-accredited investor? If I'm an investor looking at a C, then it's a lot of the same questions, but also, how do you verify that I'm accredited? And assume that those verifications are happening across all the investors. And then, you also want to make sure that, everybody's kind of in it for the same amount of money, and there's differences, but most funds have a minimum level of investment. Our level of investment is $75,000. And if, I'm an investor, I would say, oh, well, who else is in the fund? And, is someone in for a lot less or a lot more? Or, and they don't have to tell you that, but just, it's a good question to ask just to understand where you're kind of at. And most funds kind of take away some of that need to worry about that. But that's kind of the biggest two watch outs I see. And it's mostly around the 506B is, are the sponsors doing what they're supposed to be doing? Are they only talking to investors that they know? And are they only talking, and how many unaccredited investors do they have? Because you want to make sure that they're following the rules, because if they're not following the rules from the very beginning with the SEC, then there's a bigger chance that they're going to not follow the rules with something else later on. How you do anything is how you do everything. So I think with a C, I think the other option that could go poorly is, are the sponsors kind of over marketing, drawing in too much capital that they can't deploy it fast enough? Do your funds get set off to the sideline because they're raising capital too fast? Do they have the deal flow in order to support that? And for a large like syndication of a multifamily or a mobile home park or something, that might not matter because there's a cap, right? So generally funds are either evergreen or they have a set term. So let's say it's a large multifamily. They only have 6 months or so, let's say 6 months, to raise that 25 million that we talked about before. After that, the amount is capped. They either get the money enough to buy the property or they don't. And then there's no more raising after that. Other funds like mine, which are evergreen, we're constantly raising new money. Some investors may be asking for their money back. We're issuing new loans are coming back. There's this constant flow of capital. And so looking at the structure and trying to understand, like, okay, are these sponsors, are they doing a good job of managing my money? Are they over raising? What are the risks there? And I think that's just generally having a good business savvy and understanding where they're at. And then with all funds, probably the biggest thing to look at is, what is the fund's experience and what is the fund manager's experience? Everybody in their prospectus or in their pitch deck or in their documents is going to show a hockey stick, right? We're going to start out here and our money's going to skyrocket, up and to the right, or up and to the left. Yeah, up and to the right. And that all looks great on paper, but when rubber hits the road, when they start operating, have they shown that they can operate in the past? Have they shown a level of integrity in the past? And sometimes, especially when you're getting started as a fund manager, coming from my side, that can be hard to get over because you don't have the background of, this is how many deals I've done. This is the fund I managed before that killed it, right? Everybody's got to start somewhere. And so the way we as the fund managers not really got around that, is I had raised up to about $10 million prior to my fund to buy rental property. So I had a good track record there. We had done about almost a year's worth of loans prior to even starting the fund, which had always shown a good track record. And then it just came down to building trust and building rapport with my investors and providing a really strong return. We know as the fund managers that this fund that we're in, we as managers won't make as much money as maybe some other manager might make in their fund. But that's okay, because those managers have had years and years and years of track record. Their investors go into it knowing that they're going to make really solid returns, and it's very, very safe. With us, we were willing to give away a lot more to our investors up front to build that track record, with the hopes of, we'll run this fund for really, really well for 3 to 5 years. We'll get a full audit a couple times, and then we'll be able to use that as a platform to spring off to raise, 100 million, 150, 200 million in a decade or half a decade or so. So everybody's got a different strategy. It just depends also on what you're doing. Are you doing multifamily? It's going to lock you in for 5 years. You're doing an evergreen structure like we have. There's so many different ways to conform and restructure these things that can really work to the benefit of both the sponsor or the GP and the LP investors. So another fund structure that you'll hear about kind of regularly now, and one that's relatively new, is the Reg CF, or crowdfunding. Now, this one's interesting because those previous two structures were basically designed for accredited investors. Even the B is really designed for accredited investors, putting large amounts of money. Now, I say large amounts of money, I'm talking like $50,000 to $100,000 or more all at one time into a fund. But what about all those people that see all the money that the wealthy are making, but they only have maybe $5,000 or $10,000, but they want to invest that? Well, most investments in the Reg C, 506C or 506B aren't going to take that because they've got a minimum investment size. But with this new Reg CF that came out, now those sponsors are able to basically raise money in mass from the average person. Think about, I've got a great example, Grant Cardone. Grant Cardone, this is what he does, right? So he's got $100 million property that he's trying to buy. He needs the same $25 million to raise. So instead of doing a Reg D, 506B and raising 25 million from 25 high net worth individuals, he's going to put this crowdfunding offer out there where anybody and their brother can kick in 2,000, 5,000, 10,000, whatever they've got up to a certain percentage of their total, annual income into it. And so instead of having 25 investors, he maybe have 10,000 investors to get the same amount of money, but he's able to draw from a much larger pool of individuals. And I don't think so. I think some of the drawbacks of this one are there's a limited amount of money. So in that case, he wouldn't be able to do that because it is a $5 million maximum that you can raise per any individual entity on an annual basis. And then the other constraint is, like, if I just went out and put on Facebook, hey, I'm looking for money, I can't just have people Venmo me money. Like, there are specific platforms that are out there that, think of Fundrise or some of those other platforms like that, that those individuals will invest their money into. And basically, I would put my deal on that platform. People would go there. They would invest money into that deal. The money would come to me as the sponsor minus some percentage that the platform takes. That's a requirement that this third-party portal has to be used to basically raise this money. And so I think Fundrise is one, Republic is one, Start Engine is another. There's several of them out there that all specialize in helping the CF crowdfunding. So, I think some of the pros to this is there's really low threshold for investment. So if you're not an accredited investor, you want to still get into some investing, especially on some of these large, like AAA, A+ quality multifamilies that Grant has, or some other properties or other investment opportunities like that. This is a great way to get started for relatively low risk, and low risk dollar wise, right? Maybe not low risk in the deal. That's a deal by deal basis, but low risk from a dollar standpoint. It's really given the opportunity, similar to what like Robinhood did to investing in stocks. It's democratizing the ability for the everyday person to invest in funds. So no longer is it the fat cats from Wall Street and all the very rich and super wealthy just getting richer. Now there's an opportunity for the regular Joe to take part in some of these things instead of just being locked into mutual funds and ETFs and stocks. And the platforms that they have to invest online are really simple to use. Think of Robinhood. Think how easy that is to pull money from your account, buy some stocks, sell some stocks. Same concept, maybe just a little bit longer holdover time, which is one of the cons to it. Is if I'm an investor and I put, let's say I put $2,000 in, and then all of a sudden I need half that to come back because I need to pay my rent. Like, a lot of times that money's locked up for a long period of time. And we'll talk about the different actual structures in a second here. But let's say the money might be locked up for 4 or 5 years, right? And a lot of sponsors will kind of combat that, especially with these CFs, to help people out. But you really shouldn't be investing money in something that's supposed to be for a long term, unless you have that money and you can spare that money. If you're going to put $2,000 in, just plan on that money being there for half a decade to a decade. It's really not going to do anything if you pull it out within a couple of months, because the more time, I heard a great quote. It was, money is like soap. The more time you handle it, the smaller it gets. And I think this is perfect, right? Because every time you touch a trade, or every time you touch an investment and do something else with it, someone takes a little piece of it, percentage here, percentage there, and that just like shrinks it down. So money investments are like soap. Every more time you touch it, the smaller they get. So they're really this crowdfunding is really good for startups. Think of Kickstarter. It's a great example of like people going in, looking at new business, new ideas, and funding those. They're great for testing demand. Maybe I want to buy, this huge multifamily thing, and I need $3 million to just get it off the ground. I can kick this out there, see if it's going to take wing. And if it doesn't, then I'm not out anything. And if it does, then I can raise the rest of the money from a different source, right? And so it's really great for testing the market to see if there's a demand for that, especially with a product base versus a real estate based product. And then I think some of the watchouts here is that a lot of these small startups and a lot of these kind of smaller things, they can fail. Now, if you're putting your money in real estate and the operator and you're doing all your due diligence like you should, well, then your chances of failing go a lot down. It's when you see some new product that you see on Facebook and it looks great, and you put $2,000 in, and then find out that the owner of the company went and bought a Lambo and stuff, and then the company failed. You didn't do your due diligence. You didn't look at the track record. as all things, do your due diligence, do your research, and then make an informed decision. Don't just gamble, because that's what you do. If you're not doing your research and doing, look, you're just gambling. And if you want to gamble, go to a casino. So, and then there is a chance of diluting out your stock. So let's say you're in at the very beginning, and you put a bunch of money in and you're a high percentage of the overall investor pool, and then they have a huge run of investments and all of a sudden you're a very small percentage. Maybe it doesn't matter, maybe it does. It depends on the style or the type of investment, type of structure that they have there. So those are kind of the three main ones that I see a lot, specifically around the real estate space. Now, if we go just maybe one step down and we look at funds, we'll maybe take CF out of it, or crowdfunding out of it for a second. Let's just talk about within a fund B or a fund C, what are the kind of two types of fund structures that are within those. And this is where investors really start caring a lot more. Up to this point, most of that stuff, the SEC structure stuff, is handled by the sponsor. And other than a few things to look out for as an investor, not as big of a deal. But this piece here is a huge deal, because it has a huge implication on how long your money's locked up for, what your potential returns are, and do you get any tax benefits or not. And really, this is the fund, whether a B or a C, is the fund a debt fund or an equity fund? Now, what do I mean by that? Think of equity fund as something that holds something hard, tangible asset, right? So this could be a hedge fund. This could be a multifamily property, a mobile home park, something that has some hard value. You could go out and touch it. And so then there's the debt funds. Debt funds are basically like banks. Okay. They're not owning anything. They're transacting paper. So I invest my money in a debt fund. They take that money and create a loan. Versus an equity, I invest my money in an equity fund. They take that money and invest in a piece of property. Very different. Either can create a ton of economic value for you. It's just a matter of how they're operated. So I myself run a debt fund, and basically we do exactly that. We take investors' money, we loan it out to other investors, we service those loans, and then we return a pretty nice return to our investors at the end of each quarter and at the end of the fiscal year. One of the nice things about debt funds is they're very fluid, and in that they can be structured very to give a lot of liquidity to the investor. Sorry. What I mean by that is, if I'm an investor and I put money into a debt fund, there's a good chance that I'm going to get monthly or quarterly payments, because the borrower that's borrowing the money is paying monthly interest payments. There's a good chance that if I want to get my money back out in 6 months, a year, 2 years, I can pretty much call my money back whenever I want. And the sponsor will work to get that back to me pretty quickly, because it's not tied up in an asset. Now, on the other side of that, if I have an equity fund and I say put $100,000 into that, and they use that to buy a large multifamily property, and they're in the process of renovating that, and all of a sudden I say, hey, I want my money back. Well, your money is in a piece of real estate right now. They can't sell that whole property to get your $100,000 back. And generally, the equity funds have a long time horizon on them. I mean, you put your money in, and like they're looking at a liquidation event in 5 to 7 years. Right. And so it's kind of set it and forget it. Additionally, a lot of times those assets aren't cash flowing day one. It takes a year, 2, 3 years before they maybe start putting cash out. And sometimes you don't see a return at all until that liquidation event at the end. And then you see a big payday. And so the downside of a debt fund over an equity fund is, as a debt fund, I don't own any hard assets, which means that I can't claim depreciation, which means that I can't take any tax benefits. So basically, depreciation is that the IRS says that everything that I own in a house or a property slowly degrades in value over time. And every year I get to take some of that value and take it as a loss on my taxes. Now, if I make a ton of money every year, that means that I can take some of that loss and apply it to that ton of money that I made on my taxes, and I can pay less taxes. As a debt fund, you don't collect any of that depreciation, right? And so you can make a really good return on your money, but you're not going to get any tax benefits. On the other side, the equity fund, you may or may not get a good return on an annual basis, but you can collect all that depreciation. So you got a large building, let's just use raw numbers. Let's say you paid $100 million. You may have $10 million worth of depreciation that's captured every year that can be segregated out or split up by the investors in there. Let's just say there's 10 investors in a $100 million deal, and there's $10 million worth of depreciation. Each investor can take $1 million basically paper loss on their investment that then they can apply to their taxes to some extent. Not a CPA. Don't take my word for it. Go talk to your CPA. And they can take that, put on their taxes, and then pay either significantly less or no taxes, depending on how their taxes are structured. And this is how the super rich that hold a ton of real estate are able to not pay taxes on an annual basis, because they have tons and tons of depreciation, either through just straight depreciation on the properties, or they'll come in and do a cost segregation study where they break apart everything. The carpet's worth this, the paint's worth this, the office furniture is worth this, the whatever is worth this. And they get this big report that shows this how much depreciation you can take on an annual basis. And they use that to draw down their taxable income and thus pay less taxes on an annual basis. So that's the big benefit of an equity piece. Additionally, I think that with an equity piece, you're betting on not only the sponsor, the operator, but you're also betting on the property, right? It could be the best sponsor in the world, but if you get a property and it's in an area and then all of a sudden something terrible happens there, like that property is not going to appreciate, it's going to hurt your overall return. Conversely, in a debt fund, those are spread out a lot more because they're doing loans in different places. You're putting a lot more of your bet on the operator themselves and their overall business premise that they're taking to market. So those are just different things. It depends on your risk level, depends on what you're comfortable with, depends on a lot of different things. But you should understand what the difference between a debt fund and an equity fund is and how that's going to impact you. Because if I have my daughter's wedding coming up in 2 years and know I've got a whole bunch of money that I'm going to need to be paid, like I'd be looking a lot harder at debt funds that I can put my money in, make a good amount, pull it out when I need it, and use it for that, if that's what you want to do, versus an equity fund where you may put your money in and not see it again for 7 years, right? And each fund will be different depending on how much you can make. So those are kind of all overall pieces of talking about the 506B, the 506C, the crowdfunding. I don't think there's any one that's better than the other. I think they all are different tools within a fund manager and an investor's toolbox. And it really comes down to what you as the investor are comfortable with, what type of investments you want to make, what helps you sleep good at night, who the sponsor is, and where you are at from a investment strategy standpoint. Someone that's in their 30s, may be more aggressive in their investments than someone that's in their 70s, right? Just based on where they're at. And so that should play a role in how you're investing, because if you're in your 30s, you've got a lot more time to make mistakes, take bigger risk, try to hit more triples or doubles or even home runs, right? And then if something goes wrong, you have a lot more time. If you're in your 70s, I wouldn't say you're on coast mode, because I don't think anyone should ever be on coast mode, but you want to be a lot more defensive in your investment strategy, because there's a lot less time, and overall time is the biggest key. The best investment of the world done in 6 months isn't going to return nearly the return that a mediocre investment over the course of 60 years will return. So that's just kind of a high-level overview of those structures, the debt versus equity there. And like I said, I'm managing a fund. I do this on a daily basis, looking at this stuff. And I'm constantly learning. I wouldn't talk about stuff that I don't know about. And I've done a ton of work on the 5B and the 6C, less so on the crowdfunding piece, but I'm very confident in that we made the right decision for what we were trying to do. And I want to make sure everybody out there has enough information to at least get a high level understanding of what those things are in case they ever hear them. So, if you like this, if this was beneficial to you, subscribe, comment, review the podcast, and we will see you next week. Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show For more tips, resources, and updates on my journey, follow me on Invest with Lauren. Let's keep building wealth, one brick at a time. See you next week.